Okay, the first instrument is government investment issues. So for the definitions, GII is a long-term non-bearing government security based on Islamic principle and issued by governments of Malaysia for funding development expenditure. GII are issued through competitive operations by Bank Negara Malaysia on behalf of the governments. Funds are used for development expenditure. GIIs are issued with original maturity of 3 years, 5 years, 7 years, and 10 years. The issuance size are varying from 2 billions to 5 billions. Okay, next is the purpose of its creation. The main purpose of its creation is raising reserves from the capital market and use the funds for Malaysian development expenditure and utilize the funds for the working capital of Malaysia. Other than that, this instrument also issued to supply a liquid instrument that fulfill Islamic Bank's statutory reserve requirement, also known as SRR. Okay, government investment issues known as the Government Investment Certificate in early of 1983. This security is governed by Government Funding Act 1983. The Malaysian Parliament agreed requiring Islamic Bank to keep liquid paper to satisfy the liquid requirements based on the Sharia principle. The terms of GII should be regulated and interpreted in compliance with law measures. There are two Sharia concepts, which is Murarabah concept and Bai al-Ina concept. The GII will issue and settles to form main process involving two counterparties, which is governments and financial institutions or investors in Malaysia, with the concept of Bai al-Ina concept. So under the Murarabah concept, more issuing and settlement steps are parties such as commodity broker A and B, Bank Negara Malaysia, governments and financial institutions like investors are required. Okay, next I'm going to explain about the parties involved and their rights in this instrument. So there are the 4 parties involved, which is government, Bank Negara Malaysia, investor or financial institutions, and commodity broker. So for the governments, they have rights to decide and issue the GII and to pay and settle of GII according to the Islamic law. So for the Bank Negara Malaysia, they have right to give advice and be a banker to the government, and they also can collect and make payments on behalf of the government. So for the investor, they have rights to know the relevant details, trade and the cost. And for the commodity broker, they have right to trade commodity to the central bank, and they also have right to set value for the commodities. Okay, next is the obligation of each party. So the government's obligation is to design and execute GII issuance programs. A well-designed issuance policy considers government financing, risk management, and development goals in the domestic market. Other than that, the government's obligations to pay the buy cost is securitized in GII sort and given to the investors. So for the Bank Negara Malaysia, BNMs will act as the banker and advisor to the country of Malaysia. Bank Negara Malaysia will advise on the particular of issuing government securities and advance such as publication across various advertisement mechanisms which it trains and monitors. BNMs also plays an important role as an investment agent. So for the investors, the investor responsibilities include in understanding the investment in risk involved in the GII, closely reading the transaction agreements, conducting homeworks on the project before investing to understand the mechanism and framework involved in GII. So the last one for community broker is community brokers are expected to perform their business in a way that reflects integrity and dignity. So when dealing with the investor, brokers should be truthfully and share confidential information important to their investment decision. That implies the implication of such a decision. So governments will face risks like debt risk, price risk, and currency risk. So Bank Negara Malaysia will face like exposure to foreign exchange risk, and they also may face like excessive exchange rate variation that have detrimental effect on suku external issuance. So for the investor or financial institution, they may face like interest rate risk, inflation risk, and or credit rate risk. So for the community brokers, they may face risks like community fund risk, headline risk, optional risk, and legislative risk.
Okay, next I'm going to explain about the benefit to each party. So for the government can raise capital money market to finance the needs of the governments. So government also can boost the country developments and keep working capital productive. So next is benefit for Bank Nagara is to reduce the money supply of economy by selling GI. So this can control the inflation rate. So for the investors and financial institutions, these instruments can provide liquidity to the investors and can protect investor from the inflationary effect. So for the commodity broker, they can minimize the risk that involved in the trade. Then this commodity broker also can trade commodity according to the Sharia principle. And next, I'm going to explain about the pricing mechanism that involved in this instrument. So the first pricing mechanism is inflation. So inflation will be rising the actual return of the bond generated fixed interest payment. Therefore, the inflation is projected to have a major effect on the debt market. Inflation shock will also raise the nominal interest rate. Inflation will erode the actual gain that borrowers and are going to get as it allows the profit gain to the declining buying power. So the next one is the interest rate. So for the interest rate are indications of the economic situation and will impact bonds or market in Sukuk. Interest rate will also have negative impact on bond issuings and on Sukuk, as the principal of the bond or Sukuk will declining as the anticipated interest rate increase, rendering the bond less attractive to the buyer. So the next one is a gross domestic product. So a GDP has been used as one of the indicator for analyzing Sukuk business developments, and the result revealed that economic progress has a clear positive correlation with Sukuk industry growth. Effect on income means that when a country grows as its capitals, it increases the community investable revenue. This will contribute to higher demand for financial products like Islamic bond. So how is the instrument traded? So for this, the tendering takes place through the fully out electronic tendering method. The coupon rate calculated on the compelling offer weighted average. Successful bidders are determined using agreed lowest yield, and the coupon rate is set at weight average with bid value. The exact size of the issuance should be announced a week before the date of issuance. Okay, these instruments are regularly traded in secondary market with the annual turnover hitting 240 billions in 2011. So most widely exchanged GII is the range of 3, 5, 7 and 10 years. Secondary exchange GII conduct through an Islamic contract known as Buy al-Dina. So actually for this instrument they're using the tendering system known as a FAST, and the information can obtain from the major newspapers, so they will publish this at least 5 business days before the date of request. So this information also can obtain from Bloomberg's and Reuters. So for the how does the instruments used in a bank treasury operation? So through selling GII, the treasury improves the economic equity viability. Shrinking currency supply means less inflation. If the money supply is stable, then the inflation will increase. If the money supply is low, then fewer inflation will occur. The purchase of the government's bond on the market drives down the money supply, thus reducing inflation. For the questions, are there any official guidelines regulating these instruments? Yes, there is a official guidelines that regulating these instruments, which is Government Financial Act 1983 and Malaysian law. So, the Government Financial Act 1983 requires the governments of Malaysia to grant the GI to raise the funds in compliance with Sharia standard. Malaysian law also play a significant role in regulating the terms and conditions on which GI protection is provided. So for the questions, who are the regulating agency? The Malaysian bonds market is regulated by three regulatory agencies, Firstly, as the supreme regulator in Malaysia, the Security Commission assumed responsibility for regulating and developing the capital market. The second, the financial minister has authority over certain of the legislations related to the GII. Third, the Bank Negara Malaysia control approved entities to maintain the monetary stability and financial structure prudence.
Hi, I'm Divya Kanunkumar. My mentor number is 259372. Now I'm continuing with Repurchase and Reverse Repurchase Agreement of India. A legal definition under Reserve Bank of India, RBI Act 1934 of Repo and Reverse Repo. Repo is borrow fund mechanism for the sale of shares with an obligation to repurchase shares on a mutually accepted future date at a negotiated price that pays interest on borrow fund. Meanwhile, reverse repo is a loan fund mechanism by the buying of securities with an obligation to resell securities at a mutually accepted future date at a negotiated price that requires interest on the repayment of the assets. The purpose of this instrument has been established in order to obtain cash or securities. A bank needing cash not having the necessary securities may enter into a repo transaction with another institution by selling the repo securities in order to purchase cash. Other than that, repo and reverse repo have both been developed to fund big securities positions which are used to develop long-term leverage securities markets. For example, an investor uses cash collected from an initial repo deal to purchase securities that in fact are repaid to collect more cash to buy more securities and so on. As a result, the interest level of each deal is improved. Repo as a regulated history in India as a business instrument. Regulation of demand for repo falls under the control of RBI. Repo trading in India was introduced under the Securities Contract Regulation Act 1956. Until 1987, banks and non-banks bodies such as public sector institutions and private organizations were able to buy back government securities and public sector bonds. Nevertheless, this activity was banned by RBI in April 1987, and in December 1987, units of the Unit Trust of India were declared ineligible for repo transactions. Moreover, the large-scale abuse of repo prompted RBI to forbid repo between banks and non-banks. The parties involved in repo is dealers, cash inventories, and clearing bank that function as intermediaries between dealers and investors. The repurchase agreement repos are conducted only with primary dealers. Meanwhile, the reverse repurchase agreement reverse repos are conducted with both primary dealers and with an expanded set of repo counterparties that includes banks, government, sponsor enterprise, and money market funds. Reverse repos are commonly used by businesses like lending institutions or investors to lend short-term capital to other business during cash flow issues. The rights of seller or borrower is sells leverage to the lender at a specific price with an option to buy back the difference at a set time and amount. The rights of buyer and lender is provides the borrower with a cash loan backed by the shares issued to the creditor and repurchase it from the investor. The obligation of seller or borrower is, since it is effectively a collateralized deal, the lender will not be able to repurchase the securities sold at the maturity date. The obligation of buyer or lender is the purchaser may maintain the security and liquidate the security in order to recover the cash lent. Security, however, may have lost interest before the start of the trade because security is subject to price fluctuations. Risk to seller or borrower is when the worth of the defense is greater than the negotiated terms. the borrower cannot sell the difference back. Risk for the buyer or lender is, since the borrower only has temporary possession of the property, these arrangements are also viewed as tax and accounting loans. The benefits to seller or borrower is repose as the opportunity to spend capital instantly, rendering it a vital factor of liquidity reduction activities. The scale of the demand and the supply of remainder allow for good liquidity. Benefit for buyer or lender is short-term borrowing arise owing to a lack of liquidity.
Good evening. My name is Pavitra. My metric number is 259037. Today I would like to present about pricing mechanism of repurchase agreement and reverse repurchase agreement in India. In a repo deal, there are two legs of transaction. First is selling securities, second is repurchase securities. Selling price is usually for a closer date is depending on the current market on the first leg. Meanwhile, for the second leg, uh, the price will be developed on the basis of the interest flow. Transaction-wise, both legs transactions are scheduled to purchase. Sale and repurchase prices are fixed after adjustment for accumulated coupon interest. This is to obtain the needed repo rate. If the repo rate is higher, then the current yield or repurchase price is called as a capital loss. If the repo rate is lower, then the current yield of repurchase price is said to be a capital gain. Next, how repo and reverse repo traded. It is traded between commercial bank and also Reserve Bank of India. Okay, at the points when banks in India experience temporary currency crisis, they ask the central bank, which is RBI, for loan. Bank provides qualified securities such as government bonds perceived by the RBI. After RBI gains the securities, terms and conditions of the agreement approved, RBI will charge an interest that is the repo rate in the bank's loan funds. All the report transactions will be accounted to the reporting platform FTRAC under ClearCorp Dealing Systems India Limited and some other institution as stipulated by RBI. In secondary market, repo and reverse repo aid secondary market liquidity for the cash markets. For example, India Treasuries enabling sellers or buyers to act very efficiently as market makers. Market participants are ready to buy and sell securities, providing market liquidity. Good repo markets offer them with the sufficient cash and securities access to execute those actions and basically keep secondary money market operating. Next, where and how to access this instrument. Repo and reverse repo can be accessed on the money market, which obtains instantly available funds by selling securities and at the same time agreeing to repurchase the same or similar securities at a given price after a specific period. Next, how does the reverse repo and repo use in a bank treasury operation? First, under repo operation, bank borrow money from RBI for the short term. Banks sell to the RBI the eligible securities such as government bonds and agree to repurchase the equivalent security at the same time and at a specific amount. The third party repo used in bank is to conduct the transaction between the buyer and the seller and to protect the interest of the buyer and the seller. Under the reverse repo operation, bank deposits surplus funds with the RBI for 1 day. In addition, RBI will give the bank interest rate known as a reverse repo rate. The bank used the reverse repo rate transaction to provide the financial institution with liquidities such as loan activities. Official guideline regulating this instrument is that repo should be accounted for by RBI control entities as per the repo and reverse repo transaction accounting guideline. Okay, accordingly, the accounting guidelines were evaluated and the draft guidance were put into the public domain on November 14, 2008. Okay, below are the accounting guidelines, which is the revised accounting guideline will implement to market repo transaction in government bond and corporate bond securities. However, this accounting standard will not implement to repo and reverse repo transaction carried out with RBI under the liquidity adjustment facilities. Second, contract the first leg of the repo transaction at the current market price. The readjustment of the transaction will be the difference between the first and second leg, which is consideration amount should reflect the repo interest. Okay, the last one for this repo and reverse repo, which is regulating agency. All repo transaction must be subject to the Global Master Repurchase Agreement, GMRA. In India, the repo rate and reverse repo rate is an essential monetary policy tool, which is to manage liquidity by Reserve Bank of India, led by the RBI governor. The decision is made at the Monetary Policy Committee's bi-monthly meeting. Thank you.
Hi, my name is Ranjini, daughter of Krishnan. My metric number 259278. I'm going to continue about the Treasury bills of India. Okay, so what is Treasury bill? Treasury bills are the short-term money market instrument which issued on behalf of the government by the central banks to counter temporary liquidity shortfalls. It is also known as zero coupon bonds, which has a short-term borrowing with less than 1 year of maturity period. Next is the purpose of creation. Firstly, the safety of the investors. Okay, as the interest payments and principal repayments are guaranteed by the government, the investments in the treasury bills is more safe. As the treasury bills are issued by the RBI, it carries zero default risk. Secondly, liquidity of the investment. The investment in treasury bills are extremely liquid because the investors can convert it into the cash at any times. And the third is ideal short-term investment. Okay, ideal cash can make profitable investments in treasury bills for a very short time period. Treasury bills are available at agreed rates during the weekends. Furthermore, treasury bills also as an ideal fund management. This is because treasury bills are available on periodic auctions and also in secondary markets. Next is source of short-term funds. Is also one of the purpose of treasury bills being created. In order to meet the temporary budget deficits through the issue of treasury bills, the government will collect short-term funds. And the last purpose of treasury bills being created is for the sake of hedging facility. Treasury bills can use the loan market as the protection against heavy interest rate fluctuations. Next slide. Okay. How the treasury bills is being created. Alright. Every year the government plans a budget. It decided how to raise revenues and how to spend it. Treasury bills have a duration less than a year. So treasury bills were issued in India for the first time in 1917. The current T-bills are T-bills 91 days, uh, T-bills 182 days, and T-bills 364 days. The 91 day T-bills are released on weekly auctions basis, while the 182 days T-bills auctions take place on Wednesday preceding the non-reporting Friday, and the 364-day T-bill auction on Wednesday preceding the reporting Friday. The parties involved. Okay. In reality, this market is in the hands of the banking sector by several players. They are RBI, which is known as Reserve Bank of India, and also investors of financial institutions such as LIC, GIC, UTI, IDBI, ICIC, IFCI, and NABARD. The rights of each party. Okay, for the Reserve Bank of India, the rights of RBI is to have the ability to adjust the approved amount and schedule for sale of treasury bills based on the requirements of the government of India. In addition, evolving business dynamics as well as some other related factors after providing due notifications to the market. For the investor, it is an obligation through which issuing party can raise funds with a promise to repay a fixed amount back to the lender on a specified date or as per the terms of the contract. Next is the obligation to each parties. The RBI will act as an advisor who advises on the specific of the issuance of the government securities and advances such publication through multiple advertising frameworks claimed and controlled by it. And then the investor, the treasury bills can inhibit cash flows for investors who require steady income. Okay. The benefit for each party. For the Reserve Bank of India, it will have short-term surpluses to use in treasury bills, which will have never-ending value. For the investors will receive return in the form of the differences in the values of the issuance. Which is issued price, and the value of the maturity, which is known as par value. And the pricing mechanism. Okay, the difference between the redemption rate and the issuance rate will be paid as the interest rate. They are extremely liquid and no chance of default of payment. For an instance, let's say an investor buy a treasury bills of 108 days at Rs 138,000, which had Rs 150,000 as a face value. Upon the maturity, the investor will get Rs 150,000. The difference for Rs 12,000 in the issue and redemption value is the interest earned by the investor. Next slide is how is the treasury bill is traded. Okay, the treasury bill does have face value, which is similar to redemption value. This is equivalent to bill of exchange. In another term, the face value reflects the maturity value and sold at a lower price at the stage when issues arise. Next is a secondary market. Okay, Reserve Bank of India has continued to buy government bonds as well as treasury bills from the secondary market to drive rates down in the face of growing concerns about a fiscal deficit, strike as a government expenditure, manage the loss of economics activity owing to the lockdown. As per the weekly statistical update released, the central bank executed open market operation purchases valued at Rs 16,424 crores throughout April 13 and April 17. Okay. Where and how to access this instrument? Okay, the Reserve Bank of India has launched a variety of provisions in the last few years to seek to push markets participants towards purchasing government securities such as treasury bills and long-term bonds. The information of rates is essential for investors who are looking either to buy or sell government securities. Information about the latest traded securities prices can be found on the RBI website. Besides that, the bonds list and the trade analysis are shown in the CCIL website. Liquid bonds are usually the ones with the greatest amount of overall traded volume. Next is how does the instrument used in a bank treasury operation? A modern bank's treasury division acts as an autonomous profit center and thus the participants in the business of collecting funds by issuing several instruments such as treasury bills. Whenever a specific asset or liability is generated by an interbank agreement, it will be counted as a portion of the bank's treasury portfolio. Okay. Are there any official guidelines regulating this instrument? In the case of the cooperative banks, the investment listed below the group of held to maturity should never be listed into the market and would be brought at purchase value unless it is greater over the face value. For cooperative banks, the individual script for the group available for sale can be labeled during the year ended or regular intervals. The individual script as in the category of held for trading would be labeled at every month or at a regular intervals to market. Next is who are the regulating agencies? Okay, in India, the money markets are regulated by Reserve Bank of India, RBI, and also Securities and Exchange Board of India, which is known as SEBI. The money markets are the part of the capital markets in which short-term funds are borrowed and lent. Money market instruments mature from day to 1 year. That's all from me. Thank you.